Hello everyone, welcome to Loans Australia webinar for the month of June. This month's topic, we've called it Learn Insider Secrets that the banks don't want you to know, and it's a theme around it's called the 4 phases of finance, which we're going to talk about this month over the next 30 minutes. Thank you for those of you who've joined us over the last 2 months we've been doing this. We appreciate it. And each month we're endeavouring to put out a quick 30-minute update on the market and give people some tips about how they could move forward with their investing. Most of the webinars I'm going to be doing is all about how to enhance your investments overall using finance. As we know, that's a critical phase. If you can't borrow money, you can't grow your portfolio. So we'll crack into it. We've only got 30 minutes today. Thank you for those who've already logged in. What we're going to talk about first, just so people know, is just quickly who Loans Australia are. Look, we are creative financing specialists. We don't call ourselves mortgage brokers. We call ourselves a finance strategist, excuse me. So with that, most of our clients are investors and they're building a portfolio. And that's the sort of clients that we work with on a day-to-day basis. A bit about myself, just so you know that I know a little bit about what I'm talking about. I do have a lot of qualifications. I've been doing this for 19 years now. Loans Australia, we have our own credit license with ASIC, so we don't go under some other group and not really regulated. We're heavily regulated, and we have to comply with directly with ASIC, which is great for you to know. All the checks and balances are taken care of. In terms of what we sort of do, a lot of our clients have been moving into the SMSF or self-managed super area over the last few years, so we do a lot of finance in the area, and we're specialists in that area. I've been doing finance now since about 1994, and at last count, we've just ticked over the $800 million in loan settlements. So we've done a lot of loan settlements, a lot of experience. I've talked in front of a lot of people over the last 10, 15 years on finance. The biggest group was 1,800 people. Every month now, we're doing property finance seminars around Melbourne. So if you're keen on seeing us live and learning more, certainly we'll be advertising that and you'll see it. And we've got a book on finance coming out very shortly. There's last stages of that now, which is going on. The 3 phases of mortgage accumulation. Now, a lot of people talk about you need to accumulate properties. We talk about you need to accumulate finance or mortgages. The first phase is what we call as accumulation phase. That's where you've got to build your portfolio as quickly as you can, as soon as you can. So as many properties, or we say mortgages, you're accumulating. Then the second phase is really holding those mortgages, because at the end of the day, you want to get to a position where you've got a lot of properties or a lot of assets and they're giving you an income stream. We've seen over the past a lot of people have got into trouble, haven't been able to hold the properties if there's a downturn or a change in their circumstances, and they see themselves going backwards instead of continually forwards. So we like to put strategies in place with clients to make sure they're always moving forward, and that's what we're going to be talking about now, the 4 stages of finance and how we can really always move forward. So let's look at it. This is a summary of the 4 stages of finance. Phase 1, we call it the full doc. This is where most people start with. This is whereby you have verifiable income, whether you're self-employed or an employee, and you meet the lender's strict criteria in this area. In this case, income's the main issue here, that you must meet their criteria to be able to borrow. And at the moment, we can still lend up to 99.99% of the value of the property, which is amazing. So we used to be able to lend over 100%, then it dropped back, and at the moment we're at this high level. Phase 2 is what we call light doc. This is where lenders don't use a traditional method of pay slips and tax returns. They use other non-traditional methods such as BAS, or activity statements if you're self-employed, or trading statements, or accountant's letters. So this is designed more for self-employed people, not employees. And at the moment, the interest rates are still very good, and we can get some discounts from some of the bigger banks. And in this area, we can at the moment lend up to about 80% of the value of the properties on a residential basis, and about 70 to 75% on a commercial basis. The third phase is called a specialty doc. This is where the lenders don't ask for traditional income sources, but they mainly rely on self-certification and equity in the property. And sometimes you can also use what's called an accountant's letter, or accountant basically saying that you can afford the loan, or what you earn. In this area, we can actually go up to 90% of the value of the property. So it gives a lot of flexibility to self-employed people or professional investors moving forward. Then the last phase is phase 4, called ProDoc. This is more sophisticated type of people. This is where the income doesn't matter at all. It's based on the actual deal itself. And in this case here, you can sometimes end up to the whole 100% of the value of what you're doing. It's mainly around property development, which we'll talk about as we go along. So these are the 4 phases that people can go through to continue their investing. And we'll talk a little bit more detail about it now. And then you'll see how it personally can impact you. First phase, full doc. One of the big differences or fees that people have is mortgage insurance, or what they call risk fees. And this affects you when you're leveraging high numbers, over 80% generally with the major banks. And for a lot of investors, they're going to be in this area because to grow, it's very hard for people to save a lot of money. So a lot of them are relying on equity to move forward. And some people have this feeling that they never want to pay any fees. Therefore, they've always got to have a 20% plus deposit to keep going. But that really defeats the purpose of investing. And we say, look at the cost of doing business. And if you have to pay a bit of mortgage insurance sometimes, but that gets you into another property, which should double every 10 years or so, your growth in your property far outweighs the once-off insurance costs that you pay the banks. So at 80%, there's never any mortgage insurance payable. At 85, there are a couple of lenders in the market at the moment where you don't pay any mortgage insurance, which is great. And that's for self-employed and employees. Last week there was actually 4 of them. But because of all the changes in banking laws at the moment, which next month we're going to talk about, that's been pulled back to 2 lenders. At 90% LVR, there's a range of professions out there that if you're fortunate enough to be one of them, then a range of banks won't charge you any insurance. And we've got a few cases at the moment going through of some pharmacists, a dentist and a chiropractor, where we're borrowing up to 90% on a residential basis and even 95% on a commercial with no mortgage insurance, which saves a fortune. Then we do have a lender that will lend over 100% of the value of a property, and with no mortgage insurance whatsoever, but only for a very limited range of professions. Most of it is generally around the health sector, doctors, but also now they've expanded that to lawyers, accountants, and some architects as well. But you must prove and have very strong cash flow to get these very high LVRs with no mortgage insurance whatsoever. So that's the first phase, full doc, which is the cheapest. The next phase, well, to give you an example, one of our clients, Archie, when he came to us 7 years ago, he had 3 properties. He was actually a cleaner at a hospital in Melbourne, and his bank, which is ANZ, but doesn't matter who it was, said he was maxed out on his income of $44,000. He couldn't possibly afford to buy any more properties. What he was cross-collateralized too, which made it very hard. So we looked at him, and we managed to get him in the last 6 years another 6 investment properties in Melbourne. And he had a sort of a strategy of buying cash flow positive properties, which we won't go into what he's buying now, but we've grown his portfolio using full doc finance, but just going to lenders which didn't care that his income was up to 250,000 rental income, and his personal income from his job was 45. Some lenders are dead against having that bigger proportion of rental as opposed to earned income, but we just focused on lenders who are happy to take that on board. So that was him. He stuck to the full doc phase. The second phase is what we call light doc. In this phase, most lenders will lend you 60% of the value of your residential properties with no mortgage insurance or risk fee. We've got a couple of lenders now who'll go to 70% of the value of properties. So even though light doc you can't afford, don't have pay slips, don't have tax returns, they'll still lend you up to 70% with no insurance or extra coverage. And then there are a few lenders who will go to 80%, but basically at the moment, all of them have pulled back and said, if you go to 80% under this method, we will charge you mortgage insurance, but you'll still get a very good interest rate, comparable to, full doc customers. So if you're self-employed, you can get a very good deal, still up to 80% of the value of your property. Then what we've got after that is what we call a light doc phase. With Gavin, we've got a client at the moment. He had 2 properties, 650,000 in debt, but they're worth a lot of money, 1.8 million. Unfortunately, there were some issues in the family over the last couple of years, and his income dropped. And the lender he was with put him on default rates, unfortunately, without sort of taking into account his position. He had arrears. He was saying he wanted to sell his investment property. It's all too hard. The bank was playing hardcore with him. What we've been able to do is turn that situation around and go to a different lender who understood his story. And because he was borrowing less than 60%, he didn't have any mortgage insurance to pay. He reduced his interest rate over 2% from the default rates that he was being charged. And now he's in a much better position. He never thought he had a chance. So there are lenders out there who can do things. And unfortunately, a lot of people aren't aware of what they can do. And that's where a strategist comes into practice very well. The third phase is called a specialty doc. At this phase here, at 60%, these lenders don't charge any mortgage insurance or risk fees. At 70, there are a couple, again, who won't charge it, but some who will. Once you go to 80%, all the lenders will charge a risk fee. A risk fee is like mortgage insurance. It's a once-off fee that the lender charges. So the lender is actually taking the risk on their balance sheet themselves, and so they're charging a fee to offset the higher risk because you're not proving your income via tax returns or pay slips. You can use as little as an accountant's letter to say that you can afford the debt, which helps you get the loan and grow. We've got a couple of lenders who now lend up to 90% in this area, even on the accountant's letter. And so we do have some clients who don't meet the traditional area. They want to maximise how many properties they can buy. So they're willing to go at a high LVR. So that means they're going to pay higher fees and a higher interest rate, but that's going to be offset by what they're purchasing. So it's just a business decision for them. In giving an example of that, we've got some clients that have been with us for about 7 or 8 years now. When they first started with us, they had a couple of properties. They're still worth, $1 million or a bit over. But their situation was they didn't have a traditional source of income, and they were doing little developments. And so it wasn't, you couldn't show direct pay slips and things like that because they were getting lump sum amounts of money each year. What we've been able to do over the last 7 years is build a multi-million-dollar portfolio with them. They've currently got 4 development sites in the northern part of Melbourne. And once they build all those, it would have a value of about $12 million. Now, they've only been able to achieve this fantastic result by using specialty doc type loans. So when I see these clients, interest rate and fees aren't the issue for them because they know that the benefits of what they're doing far outweighs paying a higher rate and higher fees, especially when they're doing these little developments as they've been doing over the last 6 to 7 years. So they took a business decision. Yes, we want these sort of loans. We don't want to have to put all our tax returns and things in, and maybe it doesn't show exactly what they're doing. So they've just taken this business decision to use these specialty doc products, and that's helped them grow to a massive portfolio over the last 7 years. So it's certainly achievable from where they started. In this the fourth phase, what we call ProDoc, this phase is very interesting. It's not traditional lenders aren't in this area. Some of the big banks will lend for development. They have a bit more stricter criteria, but they still will assess it based on the deal itself. And the good thing about this, it's approval is case by case depending on what sort of development you're doing. So it's more for people who are doing developments of 3+ units. We've got one at the moment for 16 townhouses. We're doing this. In this particular example, the 16 townhouses, there was no tax returns required at all. There was no proof of income. They actually had sold 14 of them off the plan, which is not always necessary, but they had. And those 14 they sold far and away covers the total debt on the development. So the banks are happy with this sort of scenario. In this case, they didn't have to provide income. They would lend on also what we call the end value of the development. So in most cases, when you're building a property, the banks will assess it based on the land value today and the construction contract, and will just lend you against that. But with these ProDoc loans, they don't lend on that. They take what the valuation will be on the properties when they're sold at the end of the day on each individual unit or townhouse or whatever you're building, multi-story. So instead of lending, on the building costs, they're lending on the end value, so you can borrow a lot more money. In a lot of cases, you can borrow enough to pay and cover all the interest on the loan. So you don't actually have to pay any of the repayments as you go along and you're building your project. And for a lot of people, that is a big issue. If you're going to build 3 or 4 townhouses and you've already got a mortgage on your house and a few investment properties, how in the world can you afford to fund a bigger project? So by understanding finance and how it works, you could take someone from doing potentially a subdivision to building 10 units overnight. Once they understand finance, and they don't have to cover the cost of the project as it's going along. So it's amazing what can be achieved in this area, and this is what we concentrate a lot on with some of our clients as they want to grow and grow quicker. To give you an idea, we've got one of our clients at the moment, Adrian. He was a builder, but he mainly builds smaller stuff. So he's building normally either a house or 2 to 3 units at a time, townhouses, and he's never done anything much bigger than that. He's got to a phase in his life where he wants to build towards retirement, but he didn't have the capital to go out and do a bigger development. He could only move along doing 2s and 3s at a time. So what we put a suggestion to him was to utilise his network. And so he went and got 3 of his friends together. Those friends used equity, or we refinanced some equity out of 2 of them, and the other one had cash. They put their money together to put down a deposit on a site in Dandenong in Melbourne. And with that, they secured the site for about $750,000, and they've just started a 12-unit construction of a 12-unit development. So Adrian, who put the deal together, and it doesn't have to be a builder, it could be anyone, he put the deal together. He went and negotiated the site, got the site approved, and organised all the plans and permits from that perspective. And he hasn't put 1 cent into the project at all. He'll get his normal builder's margin as he goes along. And all 4 people who are in the project, the 3 people who put the money in and Adrian, the builder, they all share in the profits 25% each. Now, that's unusual. Some people will share in profits. That's the proportion of what they put into the project. But in this case, they're all friends, and they decided everyone brought something to the table, so they'd share the profits in the development. Now, from this one development, Adrian's going to earn more money than he has in the last 10 years of building, just from going up from a little townhouses to a multi-unit development site. With the finance we got for him on this, there was no pre-sales required, so they would prefer to sell towards the end of the project. And also there was no income or tax returns required by the 4 of them. And 2 of them, one of them was a retired investor, 2 of them were PAYG, and then there's the builder's self-employed. So a whole mix of backgrounds. The other 3 had no development experience. Only Adrian, the builder, had some experience on a smaller scale. Now they've got it all approved. They put the slab down, which is the first stage of construction. And, in the next 12 months, they'll finish off, and all 4 will have a very healthy profit. And we've actually got a couple of other clients who are doing that now as well. This has been quite successful. And so, look, even if you might not have capital, you may have people who who can access some capital and start your investing. At Loans Australia, we like to help our clients. And, look, we're not builders and developers ourselves, but we know developers, we know builders, we know architects, all the people you would need to make a successful project. We can point you in the right direction. And obviously the structure of how you do it's important, and unit trusts and asset protection come into play as well, which we'll talk about at a later a seminar. If any of you out there watch a bit of television on station Channel 31, which is community station, I filmed a couple of programs on property development, which will be going to air in the next couple of weeks. We'll send out an email when they go to air. And I talk a bit more about how this works for people. To give you a couple more examples of what people are doing in the 4 phases of finance, we've got a client at the moment. She's a vet. She's earning $84,000 a year in wages. She's owned 4 properties, including her own occupied. They're all cross-collateralised through one lender. And that's an issue when you're building a portfolio and they're all linked together and all the titles are intermingled. It can pose a problem for a range of issues. And the problem in this case, she was fairly highly leveraged at 76%, but wanted to move forward. And the bank wasn't that keen on giving her any more money based on that one wage that she's on, and the current debt level being, nearly $1 million. We had to rejig all of that and had a look at what we could do, because there are lenders out there, full doc lenders, which she was, that prefer to lend to certain types of people. Not all lenders now want to lend to investors. We'll talk about that next month, but some lenders now will only lend 80% on an investment property, whereas a few weeks ago we could lend up to 95% with those lenders. Now they've pulled it back to 80 because of a few government changes which are happening. In this particular case with this client, she wanted to buy 2 more properties, which she now has done. We've unlinked all the properties so they're no longer linked together. She's moved her total lending nearly to $2 million to $1.9 million at an overall LVR of 88%. Now, she's actually a vet, so we were able to put her with one of our specialist health areas where she didn't have to pay any mortgage insurance up to 90%. That saved her an awful lot of money. Overall, it saved her actually about $31,000 across the portfolio, which is a massive saving for her. That's just a benefit. She was prepared to pay it, but we were able to move her to a lender where she didn't have to pay that. And at the time, there was a couple of rebates that lenders were giving on refinancing to them to attract new business. So she got those rebates as well on the existing 4 properties, a couple of lenders that we moved her to. So in terms of the 4 phases of finance, sometimes it's not a good idea to have all your lending with one lender, even though you may get a bit bigger interest discount because the banks give a higher discount to the more lending that they have. But we don't particularly just look at the interest rate. That's not that critical. What we look at is how you'll be able to move forward with your lending. Because as I mentioned earlier, it's about the accumulation of mortgages that's going to get you to your end goal. And that's, very, very important. A lot of people say, oh, what's your interest rate? But that shows to me they don't really understand what it's all about. It's not the interest rate, it's the term of the loan. So on your home loan, if you were offered a 3% interest rate from one lender and you pay that off over 30 years and another lender said you're at 4%, but you managed to pay that off in 12 years, it's that second loan, even though the interest rate's higher, but the term of the loan is so much shorter, is that you're going to pay a lot less total interest to the bank. So it's not the interest rates that are critical, it's the term of the loan, how quickly you can pay off that mortgage. So a lot of our clients, we show them a few tricks of the trade to reduce the term of the loan to save them a lot more money. So it's about structuring is a critical factor, not so much what the interest rate is. What we've got as well, it's another example here. There's another client at the moment. They own 5 properties. There was 8 loans cross-collateralized again with the one lender. And a lot of people are so busy these days, they don't have time to shop around. They think a bank's been great because they ring them up and they say, I'm buying another property. Can I borrow 105%? They say, yeah, no problem. They don't tell them what they're going to do, but they just link that property to the ones they already have. It's great for the bank. They get extra security, makes it nice and easy. Clients think, this has been pain-free. It's easy. Just fill a form in, sign here, and away you go. But the problem is, as you're growing, not all properties grow at the same level. So we've had clients who, fortunately have bought in some mining towns. Those towns have suffered in the last 24 months. So you might find that if you've got all cross-collateralized and one of your properties, well, this has happened with one client, was worth $800,000. Now it's worth $450,000. The client wanted to get equity out of another property. And because that property dropped and they're all cross-collateralized, the bank has to value every property. If they're all cross-collateralized, you want money, they value all 4 and they take an overall exposure. And this is a massive problem if you're an investor, because if that happens, this client can't get any more money. They've just lost all this equity because the valuation's gone down on their mining town property. So one of the things we like to do is get them structured properly from day one. So in this particular client, we've had to go through a few steps to get them where we want them. In the first case, we had to unlink the properties. Because there were so many properties and so many loans, we decided on a couple of phases. The first phase, we had to move to one lender to make it easy to uncollateralize them initially. We moved to one lender, though, without them all cross-collateralized, so individual 5 loans. On 3 of the loans, we moved at 90% LVR to maximise the lender's mortgage insurance capacity. Most insurers will only lend to a maximum of $1.5 million at 90%. This client's not concerned at all about the fees or the interest rate. This client is concerned about growing their portfolio as fast as they can because they've only got 16 years to go to retirement. So we maximised them at 90%, and the other 2 properties we kept at 80%. So there's no mortgage insurance on this first lender at all on those 2. We released $185,000 due to that. And then step 2, we've refinanced the 2 lenders who are at 80%, so no mortgage insurance they paid initially. And we moved them to one of our lenders at 85% with no mortgage insurance there. So we got them out additional equity on those other 2 properties, no extra fees for the client. And what that's allowed them to do is to buy a phenomenal investment property in St Kilda for $1.25 million. And we've done that at a high LVR as well, at 85% with no mortgage insurance. So it's cost them hardly anything to untangle everything. We've now got them with different lenders. They haven't had to pay a mortgage insurance on 3 of the properties. And this client's already got a buffer left over about $60,000 as a reserve. And then they're working towards another property in the next 12 months or so. So there's lots of ways to go. Sometimes you can't do everything you need to do in the first step, so we might have to take a multi-step approach. But the rule of thumb here, if you want to keep building your portfolio, we have 4 phases of finance. You might start in phase 1 as full doc, but sometimes you might have to move your way through the phases and take advantage of the rules in each of these phases so you can continue to invest. And we try and really get across to clients, not so much focusing on the interest rate and fees, because at the end of the day, they're all reasonably similar, but it's what's going to get you into that next mortgage. It's about how many you can accumulate as quickly as you can, because at the end of the day, we all want to take advantage of what Einstein said was the 8th wonder of the world, which is compound interest. That's what we need to take advantage of. And the only way we can really maximize that is time in the market. That's why we need to accumulate as many properties as we can as quickly to give them the chance to grow over a period of time. And that's what it's all about. And we here at Loans Australia specialise in getting the structures right, in putting our clients with the right lenders to allow you to borrow more. And in one of the webinars, we'll actually just focus on that, because there's big differences between lenders. And unfortunately, at the moment, the rules are changing. And that's why next month we are going to talk about the new rules of finance and how we can get around some of the changes which are happening at the moment. And obviously, Sydney being so overheated and Melbourne closely following it, they're trying to pull back banks from lending to investors, because that's pretty much what we specialise in. We've come up with some strategies to continue our clients along that path of investing and building their portfolio. Hopefully, you've learned something, a couple of tips. Obviously, today it's all general knowledge. We can't talk about your individual situation right at the moment until we speak to you. We're happy to take any questions you have. We've got a couple of minutes left in this particular webinar. As I mentioned, it's short and sharp and sweet to the point. If anyone has any questions, you can. There'll be a chat box there. You can email those through, and we can answer those now in the last 2 minutes or so. One of the things, as I've mentioned, is that next month we're going to talk about all the changes to investment lending to keep people up to date with what's going in the market. We'll be sending out a webinar outlining our next workshop. A few weeks ago, we had a workshop at the Como Hotel in Melbourne in South Yarra. We had 31 people there, which was a great turnout. And we talked about a 2-day basic workshop. The first day's on education, and the second day's actually on a bus looking at sites around Melbourne and working out why you invest in certain areas as opposed to others. The differences between townhouses and units, and the sorts of things that we do in that regards with one of our property partners who does that. We do the lending. So if there's any questions now, happy to take them. We've just got a minute or so left. Someone's asked about the LVRs, what sort of LVRs they can expect now for investment. LVRs, for those of you who don't know, is just the lending ratio, what the banks will lend against the value of the property. Look, at the moment, as I mentioned earlier, some of the banks have now pulled that back to 80%. We still do have a few lenders who will lend to 90 or even 95% for investment purposes, and they will still do that on an interest-only basis, which is one of the big changes about the banks not wanting to lend on interest-only, especially on home loans, which is a bit of a problem. So, look, we can do it. It does take strategic planning because there's not many lenders out there that will lend that high. And what we found, some clients getting caught too, if they bought in a development and everyone's maximising their LVR, banks have certain exposure levels in each development they go into. So that's why we always like to get our pre-approvals in as quickly as possible, so we can maybe lock other people out who want to use a lender that we might be going with. So look, maximum 95%. But and a lot of lenders are moving towards this 80% level. Again, we don't want to cross-collateralise. We want to keep them separate. Any more? Someone's talked about here, they're having some issues potentially around negative cash flow or negative gearing and how to maintain their portfolio. Haven't got enough time now to go into that, but that is actually one thing that we do cover in our workshops about how to cure negative cash flow. We've got quite a few ideas and thoughts of what other clients have been doing. That's one of the benefits of our workshops. We go through a lot of examples as to what people are doing and how they maintain their portfolio, what sort of properties they're purchasing, and how they can maximise their borrowing capacity moving forward. Just about out of time. I just want to thank everyone who's jumped into our webinar during the day. Appreciate it. Hopefully you got something out of it, and please email us with any ideas or questions you have, or any actually topics that you want us to cover each month. We're happy to do that. All the best, and I hope to talk to you soon. Thank you.